American tax dollars will help our allies who fought so poorly and surrendered so readily.
To make good on this drunken boast, Truman authorized the one-time printing of the largest denomination currency ever, a $1 trillion bill.
Ooh, a $1 trillion bill.
Hey guys, Rafi here from the Endgame Investor, and today I want to go into something short but critical on the relationship between money supply growth and stocks and how gold and silver are related to this. Generally speaking, the faster money supply grows, the higher stocks and bonds and equities generally go. If the money supply growth rate falls below zero, then crashes are very likely, and I will show you this on the next chart. However, it might be changing now because until the curved era, most of the money pump, practically all of the money pump that came from the Federal Reserve went straight into banks, and banks buy assets, stocks, bonds, real estate, that kind of stuff. However, since 2020, much of the money printing has gone straight from the government to consumers. So a lot of it has gone straight to the consumer sector of the economy, and consumers bid on consumer goods more than they bid on stocks. Yes, some of the bailout checks have gone into stocks and savings and Bitcoin and whatever and other speculative assets, but much more money that you give to consumers goes to consumer goods rather than into stocks, because a big bank is not going to buy groceries. They're going to buy assets. Now that that's changed, the point is that the correlation between money supply growth and stocks might not work anymore, which is why we may be seeing bubble stocks, momentum stocks starting to sell off, even though the money supply growth rate is above 12%. Let's go to the chart. First, we'll go to the bottom here. This is a chart that I jiggered based on the calculations of the late, great Robert Wenzel of economicpolicyjournal.com and targetliberty.com, who passed away recently, one of my mentors. He calculated money supply growth as a quarterly average that is annualized, and this is that chart going back to 2006. Here, you can see this is the growth rate of all of money in the U.S. banking system, estimated by M2 that you can find on Fred. Here is the 2008 financial crisis around September 2008, when the money supply growth rate fell below zero, meaning the absolute inflation rate in a monetary sense was falling. Inflation had stopped right here when the money supply actually shrank in absolute terms, and that caused a huge crash. After that was the Fed's reaction, and the money printing rate edged near 20% after that, then fell again as market forces tried to deflate, and that didn't cause another crash because stocks were already at levels that were much lower than they were over here. So there was no second crash here as stocks had already deflated. The next major crash that we saw in stocks happened around here. This is August 2015. Money supply growth rates tend to bottom in August, and here they bottom just above zero. The inflation rate had basically slowed to nothing for just 2 or 3 weeks, and that was a huge flash crash. I think the NASDAQ dumped over 1,000 points. It was some kind of record at that point. I was short the market several weeks before this happened. I saw it coming. We see what happened here. This is the spike to around 50% annualized growth, an all-time record. This is monetary hyperinflation, 50% growth of the money supply annualized on a quarterly average basis. Now here, this is when they stopped the money printing, except it stopped at an elevated level of 10%, which is basically near the upper bound before then. And it went up again here, and then descended a little bit into August, which is the seasonal time for it to descend. And now it is back up to about 12.3%, and that is very high historically. So why are stocks falling? Here is my theory. This is the chart from Fred, the Federal Reserve Bank of St. Louis, taking these stats of federal transfer payments, means from the government to people, to people's checking accounts since 1971. I plotted it since the end of the gold standard. And here you see there was a little bit of a bump in 2008 recession when there were a lot of bailouts at that point to consumers as well, but nothing at all compared to what has happened since 2020. And if you download the Excel spreadsheet from where you can get this chart, then you will see that the cumulative increase of transfer payments since this trend accounts for $8 trillion more than what would have otherwise been transferred to consumers on a quarterly basis. So the money supply itself has increased by about $6.3 trillion since the Kruger era, and 8 trillion has been moved from, if the money is moving from the government to consumers, then that government needs the money from somewhere. It gets it from banks that buy its bonds. So the banks that buy its bonds transfer the money to the government, and the government transfers the money to people. So as bonds increase in banks' balance sheets, not just the Fed, but also commercial banks, that money is transferred to consumers. What, my friends, is that high money supply growth rates used to correlate to higher stock prices, but that was when much of the money that was being printed and the money supply being expanded was being expanded by banks and into banks' balance sheets. However, now that a lot of the money is going into consumer goods, that is one of the reasons why we see higher consumer price inflation than we've seen in many decades. And now that most of the money, or a lot of the money, we don't know exactly how much, a lot of the money is going straight to consumer goods and the consumer sector. That does not stimulate stocks. That depresses them because that impacts earnings. So why have we seen stocks fall even though the money supply growth rate is so high? Maybe because a lot of it is going into consumer goods from transfer payments. Where does gold and silver come into this? When much of the inflation is going straight to the consumer sector, that is when the currency is dumped. If we see higher money supply growth rates and lower stock prices with higher commodity prices led by gold and silver, that is the beginning of the spiral. There are a lot of different indications that I've gone through, and this is another one of them. If money supply growth rates keep climbing as they are, they're at 12% and climbing again, and stocks continue to fall anyway, but commodities continue to climb, then we are probably in the final stages of this. This is Rafi of the Endgame Investor. You can support me by getting a free 2-week trial to the Endgame Investor, where I cover this in much more detail, or you can sign up to be my patron on Patreon. Links in the description below, where you'll get my weekly biblical commentary from a freedom, liberty, and Austrian economics perspective. You will enjoy it if that is your outlook on life, as is mine. We will see you in a few days, possibly tomorrow.